Well, hello everybody. Michael Silva here. You're watching the Stock Market Brief Show. Today's date is May 19th, and I want to talk about the NASDAQ composite. We'll get into the nitty-gritty and go over some really cool indicators today, but I want to, talk about, hey, are we near a potential bottom? And when I say bottom, I don't mean, hey, this is the bottom, we're not going to go any lower. There's a difference between a bottom and there's the bottom, right? Everyone tries to call the bottom because it gives that Hollywood effect. It's like, hey, they might make a movie about me and then I could be known for something, right? Just like Michael Burry caught the very top of, well, I don't know if he caught the very top of the market, but they made that movie The Big Short about him. I'm getting off track already early into the show, so bear with me here. We're looking at the NASDAQ composite, tech heavy. Growth, okay? This is what I think about when I look at the NASDAQ composite. I think, it's comprised of 3,300 plus stocks, 3,300 stocks, and it is taking a big beating. It doesn't look like it looking at a long-term chart, this monthly time frame dating back about 15 years or so. But from peak to where we are right now, it's about a 30+% decline. And I want to call out way back when here in 2008 where we got it up to the upper end of that monthly Bollinger Band and we came down. That was about a minus 26% decline before seeing a nice rally. And that rally lasted for a couple of months into the middle of the Bollinger Band, which is a 20 period moving average. In this case, looking at the monthly time frame, it is a 20 monthly period moving average. Okay, now why am I showing you this chart? Well, because we are right here tagging the lower Bollinger Band. Now, there's a lot of fear out there, lots of it, okay? And rightfully so. We've had now 7 down weeks in the market, maybe 7, right? It seems like we're going to have 7 down weeks. We'll see what tomorrow brings, and we'll get into those daily time frames. But I wanted to just point out the monthly lower Bollinger Band we tagged with precision. So if you are looking for an opportunity to potentially start looking for bounces in the market, this could be a bottom, maybe not the bottom, but it could be very well near a potential bottom. Okay, where we see some sort of rally. Now, where can we potentially rally to? Well, maybe perhaps we do a very similar situation as we saw here in 2008. We rallied up to the monthly 20 period moving average. That on the NASDAQ composite is 13,736. So we'll see if that's a possibility. More than that, though, I want to call out a couple of times when we reached the lower Bollinger Band. Here, okay, the pandemic low, it tagged it, came outside of it just a little bit extra, and then we started rallying. Now, mind you, the Fed stepped in. So what's the difference between here and right here is the Fed is stepping out. The Fed stepped in right here. So will there be a time when the Fed potentially capitulates? Maybe. I'm not trying to predict when that is. I'll just listen to when it actually is. But we are at that lower range of the Bollinger Band, and there is a lot of pressure, obviously, here in the market, including growth stocks. Now, the last time over prior to that was here in 2015 to 2016. We came down. We tagged it pretty closely with precision. The Bollinger Bands got very tightly contracted, and we started rallying out through that. Yes, there was a lot of volatility. 2008, we tagged it and we started rallying up before the great financial crisis came. Now, are we going to see a potential another crisis? Well, there's a lot of fear out there suggesting that that is a very strong possibility. A lot of big time bears out there calling for it. And, I like to remain optimistic personally, right? I want to play from the long side. I want this bear market to get over and done with, but it could be prolonged until the Fed does something about it. And as it stands right now, they're fighting inflation. In 2018, right, it reminds me of 2018, right? So rates were going up, we had the repo thing going on here, and the big difference between 2018 and here, and I keep hearing the comparison is, well, here, we didn't have the inflation that we have over here right now. So it is a very sticky situation to be a part of. So, we've been trying to navigate this every single day, every single week. If you're new here, by the way, this is the Stock Market Brief Show. My name is Michael Silva. We use technical analysis, intermarket analysis to get a good idea as to where the markets might be going. Okay, so that is my idea. That is what I see on the longer term. It's always important to look at the bigger pictures of these charts. So that's why I'm calling out, hey, we're at the lower monthly Bollinger Band. Can we break through that? Can it start, expanding? Absolutely. But just be mindful that, hey, if you're taking short positions at the lower Bollinger Band, and we see here in history where we typically get some sort of bounce, it might be something worth noting. We'll get into some indicators here momentarily too. Let's take a look at the 11 sectors that make up the S&P 500. We got materials leading the way, healthcare, consumer discretionary down towards the bottom. Consumer staples continues to get hit. Now, the market really didn't do much. We did what's called a doodle, right? We doodled around that lower expected move. If you don't know what that is, well, I'll have a video link in the description on how those expected moves work, how I pull them, and more importantly, we'll go over them here in today's episode. Now, Dow Jones was down the most, and you can see here I made a new low on the chart, and that was really led by reporting of Cisco Systems. It was down 13.73%, really taking the market down with it. Now, if we take a look at the S&P 500, okay, lower risk range, right? We tagged it, we came outside of it, and we bounced right back in it. So are we going to get, a significant head outside of the range? Remember, 68% of the time, and sometimes even more actually on these liquid products like the SPX or the S&P 500, right? It closes within this risk range. And guess what? We are right there. Despite all that volatility, the options market told us last Friday where we could potentially go and what the expected move of the market was. So nothing out of the ordinary really right now. And you could see here on the 15-minute time frame, we just doodled. We just did our doodle dance right over here. Now there's going to be a lot of people calling for a bear flag, but be mindful here of where we stand on the expected move. So if we get outside of it, we can do very similar situations where we came outside of the previous expected move and we ripped right back up through it, okay? I'll go over Apple here momentarily because Apple is that laggard that really got outside of its move and it could not bounce back. It tried multiple times and we'll get into that, but let's zoom in here even further, okay? S&P 500, this is the lower risk range. We're looking at the 5-minute time frame. I talked about this yesterday. All right, and you can see here, it was right around here when the time we posted it came up after hours, right? This is, previous night. And you can see it came into that lower risk range, came outside of it, moved right back in, came back out, moved back in. During the market open, came outside. All right, so if anybody were to take that trade, boom, we saw a move up, came right back. It just doodled along the lower risk range. Now, tomorrow we have option expiration. So we typically get some very wonky type price action. So be mindful of that, right? It's not really the greatest day to go heavy, in the markets, especially if you're not really that much of a tactical trader. Now let's hop and take a look at the Qs. Qs right there down at that lower risk range too as well. We talked about that yesterday. You can see very similar. We might be forming that, what people call the bear flag. We're below that 5-day moving average. It's still declining on both of the indices that we've already called out, but we just did a little doodle dance right there at the lower risk range. So it's very, very interesting level. We came outside of it and we ripped back up and we just started, it tries to push out of it, but it comes right back in. It's the safe spot, okay? Very interesting how that's playing out. Let's take a look at a couple safety trade type assets. So we'll look at gold, right, relative to the S&P 500, utilities, consumer staples, bonds, defensive names. That's a defensive ETF, DEF, and then healthcare. And you can see still the defensive type trade is still playing in this market. Value stocks are still outperforming. Now, consumer staples, they got hit. However, they're just pulling down on a relative basis to the 50-period moving average right here. So, can we see a potential bounce in consumer staples? Yeah, maybe. They've been getting, attacked pretty hard. And when we take a look at like the FANG stocks, where we look at Facebook, Apple, Nvidia, Google, Microsoft, Amazon, Tesla, those ones have been heading downwards and relatively flat on some of them, but downwards for the most part. And when you have the relative performance and even the absolute performance of these big cap mega stocks, right? When these are heading down and breaking key levels, guess what's going to struggle? The S&P 500, the nasdaq composite, all of them are going to struggle. Now, Apple took a monster hit from a relative basis, and also it took a big hit from an absolute basis, all right? Before we get into Apple, I want to show Tesla. Take a look at Tesla. Tesla remained to be pretty calm for the most part, right? We said, hey, this is not the greatest area to short, okay, being at the lower risk range, and Tesla was a good example kind of as to why, right? It did head a little bit lower intraday, but you can see it really didn't do much at that lower risk range, okay? If we look at Apple now a little bit closer, Apple did doodle around, but you can see here it opened on the lower risk range and basically closed not really too far out of it, which tells me something, okay? As the market's kind of holding itself together, and Apple's just a huge component of all these pieces here. Apple, if it comes back within this risk range, which remember, 68% of the time, it usually does, that could be a potentially good trade from the long perspective tomorrow. I just want everyone to be very mindful that, hey, if we get further outside of this risk range, that's when things can really go haywire. And we've pointed that out previously. But I want to show you, because I took actually some Apple trades today during intraday trading, and you can see here this line is the lower expected move, and this is why it's important to know these levels. We started getting outside of it intraday, and during this time where the market kind of started doodling around, I said, okay, I'm going to probably put on an options trade, right, where the premium's already built in. I bought a couple calls, and I just held on to it, and boom, it rallied right back up to the lower risk range, and that's when I got out of the position. I held a couple runners to see if there could be a little bit more juice left in it, but it didn't. I ended up getting out when it started heading lower. I put in another trade more towards the end of the day too as well, to see if we can actually potentially come back up into that lower risk range where the premium is already built in. So if that's the case, awesome, it'll be a good trade. But just notice how it comes outside of it. It ran right back up to it. All right. And then it came back outside of it, giving us another opportunity to potentially get into a position. Bam, it came right up to the lower risk range too, within, a buck. So that would have been a good place to take some profits. And now we're back down here again, giving us 3 opportunities to potentially play intraday here with Apple. So we'll see what tomorrow brings, right? I want to be bullishly optimistic here because I'm long, but I didn't position myself where I'd blow up a portfolio if I'm completely wrong. You know what I'm saying? And if we look at the 15-minute time frame, I will point out that we do have that positive divergence both on the RSI and the price momentum oscillator, where you see the price action itself is putting in a lower high, but these oscillators are both putting in higher lows. Now, we are declining, right? So this is catching falling knife sort of material here, but we're trying to play it quantitatively by being outside of these risk ranges. Well, that's my I guess, I don't know what word I'm trying to use, but that's my take on it, okay? So we'll see here if we do get a little pop. I'm trying to look for that 140 to a little bit higher. Now, what else took place today? The dollar came, it was a pretty big down day for the dollar. So, if you are bullish the dollar, this is a buying opportunity in my opinion. We'll see if it could head a little bit lower. I'm going to be a big buyer at 102 if it can reach down there. I do want to, see if this trend will continue. I did take a little position in dollars earlier. It was up slightly. It was an intraday to slightly swing trade, and I scaled out some of that position on almost yesterday's high. Now, this is very interesting. So when the dollar took a big down hit, this is interesting to know. When the dollar pulls down, okay, guess how good gold did? Well, gold did exceptionally well today. It was up 1.47%, and look where it tagged. The upper weekly risk range, almost to a T perfectly, and then it kind of just, bowed out right there. So now gold's at the upper range, which means to me, hey, is gold going to slow down here? And we got to wait for the range to refresh, right? So is Friday going to be a muted type of day? Or is the dollar going to continue to fall, perpetuating gold potentially higher? Or is the dollar going to rise, right? Is the dollar going to come right back to it and push gold right back down? Is always a possibility. Another interesting one was TLT. So if you're watching yields, look where it tagged, the upper risk range to a T. So if you're playing this tactically, you would have known to, hey, probably get out of the position right there or lower it. As you can see, we started selling off there at the upper end of the range. So it's kind of following its trend. If we take a look at oil, WTIC, like crude, up 2.66% on the day on that dollar drop to the downside. Continued volatility here. It's above those moving averages. I was at the gas station today. I haven't been driving frequently, so I haven't been paying attention to what the gas prices were in my area. And I go down there and I post on Twitter. I'm like, holy cow, regular gas was $6.06 a gallon. And I'm like, geez, it cost $72 to fill up a 12-gallon tank, which is, I don't know how people are doing it. That's absurd. It's crazy. Let's get into some indicators. All right, so we're now working on our 7th down week here in the SPX, all right? Things are getting very, very bearish as far as the asset managers, right? The NIAM, and then also Ridex. Where's money going? You can see we're bearing up a little bit here. It's getting deeper down, which technically it's moving up, but the way that I have this set up. And then also the asset managers are running in at a 19.51, which is exceptionally low. We don't get these type of low readings frequently, right? This is pretty much right where the pandemic low was. And then you can see it's even lower than it was here in 2018. So pretty bearish. And you can use these sometimes as contrarian indicators saying that, hey, when it starts getting below these levels, start looking for longs. And I can understand why people would be too afraid to go long here. Keep in mind the price action and everything. The trend is down, right? So you need to be very tactical here. The trend, to change it, it's not going to take a simple day that moves up. Now, a couple things that I also want to call out. Summation index starting to actually level out here. So that is actually an okay sign, right? We started leveling out here, all right? And then we started rallying up a little bit. And, it took a while for the parabolic SAR to start getting back beneath this trend, and then we started rallying. But as you can see here, maybe on a positive pop day, the parabolic SAR can give us an indication that, hey, we may be starting to see somewhat of a little bit of a trend shift, and that could give us a bear market rally. And I say bear market rally because it's going to be a rally until proven innocent, all right? Or bear market rally, it's guilty until proven innocent. Okay, so that is what I'm kind of watching here. It's starting to flatten out. We'll see if that can continue. Another one that I want to point out is the Pring bottom fisher. The Pring bottom fisher didn't get below that minus 30, which I really like to see it down there, but it has gotten a lot deeper than where it usually gets. And I wanted to call out that we are seeing it start to curl back around, right? It's the early stages where this can potentially start coming up. The green line could start curling back itself up. And when that happens, you could typically mark sometimes short-term bottoms, right? When it gets really deep, like these two over here, we saw it mark bottoms here in both 2018 to 2019 and then into the pandemic crash. Okay, now another couple other ones here is the Kohan high low. You can see it is down below that 0.05, and when we've gotten there before, it has marked significant bottoms, even here in 2002, right? That was the bottom of the dot-com bust. Even down here where long-term capital management exploded before a monster David Hunter style melt up. Watch and learn, folks. Okay, and then we have the 2008. This one is the one that's a little bit more sketch, and that's why I showed you the chart at the beginning of the video, is because we started getting that bottom right here, and then we started that rally up, right? And guess what? It found the bottom here. It started moving back up. We're at the bottom here. Are we going to start moving back up? I don't know. I'm just trying to point out what's actually here on the chart and what has happened in the past, right? I know there's a lot of narratives out there saying it's different this time because the Fed is tightening, and I get it and I understand, but the chart is the chart, right? And back then in 2008, as I said, right, we were at the lower Bollinger Band. Is it possible to see a rally? Yeah, come on. Of course it's possible to see a rally. Okay, now another indicator that hasn't shown any really positive momentum is the old fool indicator, right? This is where we take the NASDAQ composite and divide it into the put to call ratio, and we apply a couple moving averages, the 21 and the 50. We want to see the green, that's the 21, get above the 50, okay, and start to cross over, because that is more bullish, right? We've seen it before, boom, cross over, we start to rally, but you can see that it has been in a bearish trend, try to move over here, right, rallied, but then crossed down through, and we saw some more downside price action. So, it's a very mixed bag. There are overextended levels to the downside. The rallies in bear markets, they can be face rippers, okay? And you just got to be very mindful of the environment. I went over a lot in today's video, and I'm not done yet. I want to go over Bitcoin. The indicator is still on that sell side, still not pointing up, but Bitcoin is kind of trying to catch its legs here a little bit, floating around that 30,000 level. If you take a look here on this specific chart, we cracked down through this bear flag, but you can see today, interestingly enough, we're up 5.3%, which is pretty powerful stuff, seeing how the other indices, right, were kind of flat to down, and Bitcoin sometimes has been leading indicator for these indices. So maybe perhaps this is, if this starts to try to find a little bit of a bottom, moves a little bit higher, it's not going to change the trend by any means by moving a little bit higher, but maybe that can give us insight into a potential rally here to come to in the indices. And if we take a look at Ethereum really quick too as well, you can see it was up 5.29% on the day, right? We tagged that lower range, which ends up being an previous area of support multiple times. The relative strength line started turning up between this and S&P 500. Same with Bitcoin. So yeah, can we potentially rally out of this? Maybe, but you just need to be on guard in this environment. You need to be on guard. Okay, everybody, that's all I got for you on today's episode. Hope it helped out and gave you some insight into what I am seeing in the markets.